In February 2025, JPMorgan did something they haven't done in years. They sold off a huge long position in silver. They didn't do it slowly or quietly. They did it all together in a planned way that surprised every analyst. The bank that took the other side was HSBC, a bank that was holding one of the biggest concentrated short positions in silver that anyone has seen in modern times. Here's the part nobody is talking about. This wasn't just a normal trade. This was a rescue move. When two of the biggest bullion banks in the world start moving huge amounts of paper silver in secret, something big just changed in how the global money system works underneath. The real question isn't whether this matters. The real question is, what do they know that we don't know? Welcome to Currency Fictions, where we explain the financial clues that regular news ignores. Before we go deep into what happened in the silver market, let me ask you something the way your grandfather might ask you to pass the salt at Sunday dinner. Would you mind clicking that subscribe button? I know, everyone asks for it. But if you like clear facts instead of noise and real information instead of hype, then you're in the right place. We'd like to keep giving you this kind of breakdown. Also, drop a comment right now. Tell us where you're watching from. New York, London, Singapore, Mumbai. Because what's happening in silver isn't just a Wall Street thing, it's a worldwide change, and I want to know where our viewers are following this from. Now let's talk about what really happened. On the first Friday of February 2025, the Commodity Futures Trading Commission put out its usual weekly report on trader positions. Most people just scrolled past it. It looked like normal numbers, but something strange was there. Veteran silver watchers stopped and read it twice. JPMorgan Chase, one of the biggest bullion banks, had quietly closed out a big part of its silver long positions. Not slowly over months, but in a short burst of trades that showed up as a huge change in the commercial trader numbers. The size was big, the timing was exact, and who was on the other side couldn't be ignored. Because on the other side was HSBC, a bank carrying one of the most concentrated silver short positions ever recorded in recent commodity history. Let's stop here and remember what normal looks like. In a usual silver market, commercial traders hold both long and short positions. They hedge for clients. They provide liquidity. They manage their own risks. Their net positions usually stay in normal ranges. Big banks like JPMorgan might hold 20,000 to 60,000 contracts net long or short, depending on the market. These are real hedging, market making, and strategy positions. HSBC usually does the same, balancing physical silver work with paper market trades. But the February numbers were not normal at all. JPMorgan's long position dropped by about 35,000 contracts in just 3 weeks. That's roughly 175 million ounces of paper silver. When the whole world produces around 800 million ounces of silver a year, that's not a small change. That's a major move in the structure. And HSBC's big short position, which people guessed was over 50,000 contracts, suddenly got some relief. The timing makes people ask questions that simple answers can't fix. Silver prices stayed in a tight range between $28 and $31 all through January. There was no big news or event that would force such a fast change, no rule deadline, no clear price reason to do it right then. Yet it happened on purpose, exactly. And with the kind of teamwork that only happens when big institutions are handling something much bigger than a regular trade. Now the interesting part starts. When JPMorgan sells its long positions, they're selling their right to get silver at certain prices on certain dates. Someone has to buy those. Normally, lots of different buyers would take them, other hedgers, algo traders, spec funds, but the numbers showed something else. JPMorgan's drop in longs matched almost exactly with a drop in the total net short position of all commercial traders. That means JPMorgan's longs were probably taken by another commercial player who needed to cover shorts. And looking at HSBC's known big short, the numbers point straight to them. This wasn't random trading. This was one big bank giving risk relief to another big bank. How this happens matters a lot. These aren't real silver bars moving in trucks with guards and papers. These are paper positions, futures contracts, and derivatives. JPMorgan had contracts that let them ask for real silver delivery. HSBC had contracts that forced them to deliver real silver. By moving these positions, JPMorgan took away the delivery pressure from HSBC's books, at least on paper. The price didn't move much. Silver dipped under $29 for a bit, then came back in 48 hours. That means they did careful block trades or exchange for physical deals that didn't shake the market. Professional work, big bank teamwork, small footprint, exactly what happens when two smart banks are handling big, concentrated risks. But the big question that takes us deeper is, why right now? JPMorgan built that long position over years. They kept it through the 2022 drop, the 2023 flat time, the early 2024 rise. They held strong through Fed rate changes and different economic times. Yet in just 3 weeks in late January and early February 2025, they decided holding those longs wasn't good anymore. At the same time, HSBC needed relief from their shorts so badly that taking these contracts became the top priority. The reasons behind it must have been strong. Either JPMorgan saw something in future prices that made longs bad, or HSBC had growing pressure that needed fixing fast, or both banks got information about the market that made them act together. The data doesn't show the motive. It only shows what happened. And what happened was unusual enough that experienced traders started asking hard questions. When the biggest players in a small market like silver move hundreds of millions of ounces of paper between themselves, the effects go way beyond one price chart. They go into questions about how the market is built, about too much concentration, about whether paper markets stay stable when real supply gets tight, and most of all, into what these big institutions know that isn't in prices yet. The move happened. The data proved it. But the real story is just starting. Most people think silver trading is simple. A buyer, a seller, a price, a deal. But when banks as big as JPMorgan and HSBC move positions worth hundreds of millions of ounces, it becomes something different. It becomes the basic structure. Financial engineering at a level most traders never see. Understanding that structure is what separates just watching markets from really getting them. Let's start with what these banks really trade. When people hear JPMorgan has a long silver position, they picture big vaults full of shiny bars waiting for delivery. But that's not how it works today. What JPMorgan held were mostly COMEX silver futures contracts. Each one has a delivery month, a price, and rules. These are derivatives. Their value comes from the real metal. But here's the key difference. About 98% of COMEX silver futures never turn into real delivery. People close them early, roll them to later months, or settle in cash. So you get a market where huge paper amounts trade every day, but the real metal hardly moves. JPMorgan's 35,000 contract drop was 175 million ounces on paper. But in real silver, probably 0 ounces moved, no bars changed places, no metal left one vault for another. What moved was responsibility, risk, and exposure. Now look at HSBC from the other side. When a bank holds a big short in silver futures, they sold contracts promising to deliver silver at set prices. If they're a normal market maker or hedger, those shorts match something real. Maybe they sold silver forward to factories, or they're protecting their own metal stock, or giving the other side to spec buyers. That's normal bullion bank work. But when shorts get too concentrated beyond normal hedging, the math changes. HSBC's guessed 50,000 plus contract short was about 250 million ounces of paper promise. At that time, all visible COMEX warehouse silver was around 300 million ounces. HSBC's short alone was almost the whole deliverable amount. That creates concentration risk. Not always cheating or wrong, but just too much in one place. If silver jumped $10 an ounce, HSBC would lose over $2.5 billion on paper losses alone. If lots of long holders suddenly asked for real delivery, HSBC would have to find hundreds of millions of ounces in a market that produces only about 1 billion ounces a year. These are real worries that keep risk teams up at night. So when JPMorgan sold their longs in a way that matched lower commercial short pressure, what really happened? Most likely through exchange for physical deals, or EFPs. That's when futures get swapped or offset with real metal positions. JPMorgan had rights to get silver. HSBC had duties to give silver. Through COMEX EFP deals, they transferred or netted those without big open market trades. JPMorgan got out without selling hard into the market. HSBC cut shorts without causing a big buy-up rally. The exchange recorded it. CFTC showed the change. Price barely moved. It's clean, smart, and almost hidden from regular people. But it shows something deep about how commodity markets work now. The price you see on screens, the spot price news talks about, that price is more and more separate from the hidden web of big institutional moves underneath. True price finding happens in these quiet bank transfers, in choices about what risks to keep or drop, in decisions about capital use. The February 2025 JPMorgan HSBC move showed this perfectly. No big headlines, no panic selling, no squeeze rally, just a huge, quiet structure change that showed how the biggest players were rethinking silver. And this matters a lot for people watching precious metals. When banks like JPMorgan, with some of the smartest commodity teams, decide to close long positions they've held for years, they're not reacting to old news. They're getting ready for what's coming. They see supply chains early, industrial orders, central bank moves. They know about tightness or extra supply months before numbers come out, so when they sell longs, the message is they looked ahead and decided those positions don't give good enough returns for the risk anymore. For HSBC, why did their short become a problem needing this relief? Probably because of bank rules on capital. Under Basel III rules, big concentrated derivatives need extra capital held against possible losses. The bigger and riskier the position, the more capital gets locked up. HSBC's huge short in small silver market was tying up money they could use better elsewhere. A price spike would force more capital calls. In a time when banks get checked hard on risk and capital, keeping that short became a problem on their books instead of a good business. So the transfer helped both sides. JPMorgan dropped longs that didn't fit future views. HSBC cut concentrated shorts that locked up capital badly. Both got better use of money and risk. The market took this huge move with almost no price shake. But the smart part is, this wasn't panic. This was careful planning, which means both banks think silver will stay in a range or maybe go a bit lower in the medium term. Not crash hard, but definitely not jump to $40 or $50. If they saw a big rally coming, JPMorgan wouldn't sell longs. If big drop coming, HSBC wouldn't need relief because shorts would make money. The move signals they expect range trading with a downward lean. For people who use silver in business, like electronics makers, solar companies, factories, this means good chance to buy forward and lock prices now while they're okay. If big banks expect range or lower prices, fixing costs now gives safety without much risk of paying more later. For investors already in precious metals, this isn't sell everything now, but it is a sign to check how much you have in silver. If the smart money cuts back, keeping too much needs strong reasons that go against what they're doing. Doesn't mean quit silver completely, just size it right for your comfort and whole portfolio. For people in silver businesses like refining, recycling, or selling coins, it means growth probably comes from running better, not from prices going up a lot. In range-bound prices, you make more by getting more customers and controlling costs, not by inventory getting more valuable. For traders, the data says big moves up or down will probably be short-lived and come back to the middle until big players change again. Range markets reward careful taking profits and good risk control more than strong bets one way. Now, what should you watch to see if this analysis is right? First, weekly CFTC reports. If JPMorgan starts buying longs back or commercial shorts grow again, that means their thinking changed. Position moves always come before price moves. Second, COMEX warehouse stocks, especially registered versus eligible silver. Registered is ready for delivery now. Eligible is there but not promised. If registered drops fast while open interest stays high, that means real tightness that could beat paper positions. Third, silver ETF flows, especially iShares Silver Trust and big physical funds. Steady money coming in means investment demand growing, which could push against the bank moves. Fourth, gold-silver ratio, now around 85-90 ounces silver per gold ounce. Normally it stays 50-80. If it drops towards 70 or lower, silver beats gold, often before banks go back to longs. Fifth, industrial signs, China factory PMI, solar install forecasts, EV production numbers. Silver's industrial use is big in these. Weak numbers support the bank moves. Strong numbers hint at change coming. Let's put it into three possible futures. Base case, 60% chance. Silver stays between $26 and $30 through mid-2025. Big players keep light positions, no extremes. Industrial use steady but nothing exciting. Investment money quiet as people pick other things. No big event breaks the range. Bull case, 25% chance. Industrial use grows faster than expected, especially solar and EVs. Investment picks up from inflation worries or safe haven flows. Real supply gets tight because mines can't keep up. Banks have to buy back longs, pushing prices toward $40. Bear case, 15% chance. World factory slowdown cuts, industrial use a lot. Investment money goes to other assets. Big players move more short. Prices test 2023 odds. The base case looks most likely because it matches what the bank moves signal. Expecting more of the same range, no big direction, but these are guides, not promises. Markets change, new data comes. The smart way isn't betting everything on one story. It's setting up for what's most likely while staying ready to switch when things shift. And that's exactly what the JPMorgan HSBC move shows. They held positions for years through ups and downs. But when their forward look said those positions weren't worth the risk reward anymore, they changed. They moved money where it could work better. No feelings, no stubborn ideas, just smart use of money based on new info. For business people handling commodity costs, for investors with metals, for people building silver businesses, The lesson is the same. Markets pay the ones who see when things change and act smartly, not with panic or emotion, but with clear plans. The February 2025 JPMorgan HSBC silver move wasn't just a trade between two banks. It was a message that big players now expect different things for silver, a message that prices will probably stay in a range instead of big breakouts, a message that smart money is moving capital based on fresh risk-reward looks. Whether that message turns out right in the next 6 to 12 months, we'll see. But ignoring messages from the biggest, most informed players in any market, that's not being flexible. That's choosing to stay blind. And in commodity markets, staying blind costs a lot. The move happened. The data showed it. History gave it context. The future signs are clear. What comes next depends on how people react to information that's now out there, and whether they learn from what the big institutions are doing or just ignore it.